see this little icon they put up there in the corner now. It says stay home just in case you forgot. You're probably watching this from home, wherever you are. So I will go ahead and get us started. Daniella Squicquero here with the Hilton Head Life and the Beaufort Life at Charter One Realty. And this is Remain Calm. This is episode 7. We are moving right along. And today I have the beautiful, wonderful, highly skilled Karen Hall, a very dear friend of mine, and also an extraordinary person in the mortgage industry. And so, Karen, why don't you tell us a little bit about what you do on a daily basis and how you got to be where you are?
So, well, I've been in the mortgage industry for 20 years. And I remember started out as a lender back in the day. And so I just found the passion for it and, learned all different sides of it. Worked for a big bank, worked for a broker, worked for a lender. So now I'm in a community bank, Ameris Bank. I've been with them for 5 years. I wear many hats, as we all know, as we do in our real estate industry. But I'm just really passionate about what I do. I'm good at it. And I try to find solutions to the problem because I understand what it feels like for that customer to be on the other side of the desk and not know what we know. So I just always wanted to be a trusted source and give them the honest truth so they can make a savvy financial decision for themselves and their families.
Well, that's wonderful. We're going to come back to that problem solving here in a minute. But what I'd like for you to do first, because you mentioned the word lender, and there is terminology, of course, as we know, that we kind of all throw around in the industry. But for our consumers, you hear the word mortgage lender, mortgage banker, mortgage broker. What is the difference and which one are you?
So I'm a mortgage banker. So I work for a bank. And a mortgage lender is someone that works for a lending institution that has their products. And then a mortgage broker, they'll take your loan and they'll source it out to all different institutions of all banks, lenders, and different investors that will place your loan to find the best rate.
Now, for those 3 groups of people, those 3 titles, what is the difference as far as the experience with the consumer? And is it better for them to go to one versus the other?
Well, I'm always going to be biased. I'm going to be biased to a banker because we're a full service bank.
Right.
So once you develop that relationship, sometimes banks will offer better pricing, because you have that relationship. But we also have that cross-selling ability to where we can help that consumer with commercial loans, SBA, full service banking, business banking, equity lines, things of that nature. So we have a plethora of products, especially at Ameris Bank. We like to think outside the box and create a portfolio brand. So we have a whole line of portfolio products that a typical lender or a broker would not have available.
Okay, well, that makes sense. So let's talk a little bit about trends, because this is really the bulk of the conversation today, and this is what everyone is thinking about right now. There was the news that came out very recently about how the Fed rate had dropped very, very low. And of course, a lot of people in their minds were thinking, and I'm hearing the chatter, oh my gosh, I got to lock in my mortgage rate. And
0%.
That's right. And so let's talk a little bit about that. What is the reality, first of all? What are the trends right now? And what have you seen since, let's call it the last 3 or 4 weeks, when all of this started really having an impact on our economy?
Yeah, so the Fed fund rate, that's for the banks to be able to lend money overnight to each other so we could offer more products. So that really affects like your credit cards, your equity lines, loan products that the bank offers. But the mortgage rates, what that kind of follows is the bond market and the MBS market, so mortgage-backed securities, which I follow the mortgage-backed securities on a daily basis. And I just keep it, up on my screen. So when you see it plummeting, you're like, oh my God, the interest rates are going to go up. But then when you see it start to rise, and that's what the stimulus bill was doing, is that the federal government was injecting money into the MBS and in the mortgage-backed securities and the bond market. So we saw probably about 2 weeks ago, the rates dropped. So at that point in time, you were just on a locking frenzy. And then after that, like after 2 days, the interest rate started going back up again. And so now today and yesterday, we're starting to see a little bit of a rebound. So now we're back in the locking frenzy. I call it the floodgate effect. Mm-hmm. So they open up the floodgates, let loans in, and then they close it right back down again.
That's right.
But the purchase the purchase rates are amazing. I mean, they're still low threes, 3%, 3.25%. Just depends on the borrower's criteria. So everybody has a different criteria. Just because they say the rates are 3% doesn't mean everyone qualifies for 3%.
Right, exactly. What would you say right now, at least for Ameris, are the most competitive products? What are you seeing that's really just an awesome opportunity right now, or is it across the board?
Well, it's across the board. I mean, we have made changes, with the COVID-19, but, your Fannie Mae, Freddie Mac conventional standard, no frills mortgage is definitely the best buy. Mm-hmm. You also have the FHA, VA, products. So those rates are in the 2.8, 2.7% range. So for those folks that can, qualify on that, the jumbo market, I mean, it's still, pretty competitive. So, I mean, there's product out there. We are curtailing guidelines, and we've only pulled maybe 3 products. I know there was a large bank that went out there and posted saying that they had to have a 700 credit score with a 20% down payment. Mm-hmm. So, I mean, there's still products. We still have 100% financing. We still do the down payment assistance. We still do government loans. We still do conventional. I mean, we have product. There's only 3 products that we pulled, and those were investor products or portfolio products.
We've been at historic lows now for quite some time, and we're kind of just hovering there as it continues, it sounds to me. Is that about right?
Absolutely. So, and if anyone's on the fence about buying, I think we're busy here in Atlanta. Everyone knows I moved to Atlanta 2 years ago, and we're hopping. I mean, the phone just rings constantly. People are buying here, but we also have an industry here. We have manufacturing, we have jobs here. So that might be a little bit different than what you're seeing there, being on the coast, being a second home resort, type community. Mm-hmm. So it might be a little bit different market as far as like the movement. Mm-hmm. But I don't really think that we're going to see, much price correction. I think you're going to see some people that may panic or may have lost their job and need to sell. But I think we're all priced right for the market. I don't think values are overinflated. And I think people that, if they can find what they're looking for, go ahead and do it.
Absolutely. And I would agree with you too. And, Atlanta being a larger market, and as you say, a more diversified economy, going down the line, all of that, it really does tend to follow those national trends a little bit more closely than a market like the Low Country of South Carolina, where we have a lot of second, third, fourth homes, a lot of discretionary purchases, which also means a lot of people who can decide at any given time, this just isn't the time for me. We do have a primary market, of course, as you well know, you were here for years and years. Yeah. But it is just a little bit different. Our variables and our drivers are a little bit different. So yeah, that is an important insight, and I'm glad you brought that up. Let's talk about refinances for a minute, because that's something that was all over for a moment there when everybody was just jumping on that bandwagon. And tell us a little bit about what's happening now. It's literally changing day by day, week by week as we're watching these things. What's going on there?
Yeah, so like I said, it's the floodgate effect. So, our pipelines are full. We're working 10 to 12 hours a day, 6 days a week. Probably some people are working a little bit more, but those are my hours. It's very overwhelming. Some of the guidelines have changed. A lot of people want to do a cash out. They want to get that equity, just to kind of hold them over during this, pandemic that we're going through. Mm-hmm. But they're still able, on a primary residence, they're still able to get those rates in the 3s. A lot of my investors here in Atlanta, those rates are, a lot higher. They're in the 5s, low 5s, maybe high 4s, just depending on their criteria. Mm-hmm. But the values are there. The cash is there, but the refinances are definitely, they're in abundance.
Yes.
I will say that. I will say that. But we're saving people money, and they want to stay in their homes, and we kind of just go through and have a little chat and talk about their story and analyze their financials and say, okay, is it worth it or is it not for you to spend the money, the closing cost, in order to do that? So like for myself, I'm not going to refinance because I want to sell, in a year and a half. So I'm not going to do it. It doesn't make sense. I'm not going to recoup my costs. That's something that I do go over with them, and we do an analysis of the cost.
Yeah. And that's important too, because at some point, the short term, it's not for that person. It's not for that person that's going to end up selling in, the next year or 2 years or whatever those numbers turn out to be. But if you're going to be in that house for a while, or at least own it, it can make a lot of sense to do that right now. So that's definitely an alternative.
Absolutely.
what is your forecast right now? What are you seeing, not only in our sort of region? Oh, I lost you.
Uh-oh. Where'd I go?
I don't know. All right, that was a quick little break, and we are back. Commercial break.
Don't you love technology?
Song. Anyway, we were talking about the forecast. So not only for the southeastern region, which of course is a really interesting area to be watching right now, but also nationally. Just what are you seeing from your perspective? What do you expect into the short, mid, long term?
I still think we're going to see monstrous numbers this year. I still think that, I think once they kind of put people back to work and they kind of see the light at the end of the tunnel, I think all those people that were on the fence, I think they're going to say, go ahead and go. We're closing loans. Wow. I mean, we're just beating our goals every month, from years past. And, we just bought Fidelity Bank. So we merged those two banks together. And even with past years, the two separate banks, and then we put them together, I mean, we're just meeting tremendous goals. And I still think that there's plenty of opportunity. Go ahead and get it now while the interest rates are in the 3%. I mean, I've been doing this for 20 years. And I remember a long time ago, I think the lowest I've ever seen a 30-year fix was 3.25%, if my memory serves me right. But
close enough.
I think we're going to still have a great summer. I still say we're going to have a good spring, and I think we're going to finish out this year very, very strong. So I think we're going to do it.